Okay, so in this video, I wanted to go a little bit more in depth into ranges and understanding the price action and the legs that are created after breaks of structure, and just kind of clarifying that a little bit more and breaking down kind of what that means and how we can begin to frame trades around that. And so it's gonna be a while before we actually continue on to framing trades, but we like everything are building off of these concepts and adding to our understanding along the way to get to that point. And so I just want to help you understand and more clearly define a range after a break of structure. And so these concepts apply to any time frame in any chart, and as we get later on in the video, you'll understand and begin to see the actual complex matrix that's happening on every time frame and how we capitalize on that. But in this example, I'm just going to show you on a 5-minute chart in this most recent price action what a actual range and that newly created range is, and what it means, and how we can frame a trade around it. So at this point in time, this is a bit of a messy example, but I mean, that's trading. There's not always going to be perfect examples. So at this point in time, we have a break of structure right here. And as soon as we get that break of structure, we can then understand that this point on the chart is our new low. And once price action develops and pulls back, we can then understand that this high is our new high. And so why, a few questions that I'm sure people will have is why right here is this not a break of structure? Well, if you're asking that, it's because you didn't actually go through the first couple lessons of this course. And this actually becomes a wick right here, okay? So wicks are not the same thing as a break of structure. When we have a wick, we can just draw our trend line straight through it to the next break of structure. So this candle right here, body does close above this old high, causing a break of structure, at which point in time price trades a little bit higher in these two candles and then pulls back down into this range, okay? And in this pullback, once you get down into this area right here and it becomes obvious that we're going to start pulling back, you can then mark the high. But until price has actually done that, so if you're watching this chart live and you can see these candles developing right here, I wouldn't necessarily get ready to mark that as a high because it's not super obvious. Like price could just keep trading up higher and then pull back. So once we see price action develop kind of in these areas here and definitely at this low, we can then start to understand, okay, this is our new high in this range. And so what is a range? A range is the area that price has traded previously between a high and a low, or it's still a high and a low, but going the other direction. So I'll go over a few bearish examples here in a second, but this is a newly created bullish range right here. And so it's bullish because we had a bullish break of structure, and price from our break of structure video we know is very likely to come back and trade into this and continue the trend at some point in time in the future. So both those topics and points are not necessarily immediate. So a lot of these examples, price is actually trading back into this zone immediately. And a lot of the examples in the previous lessons, it's happening pretty immediately. But there's nothing that says price can't blow way up here and then days or weeks later trade back into this zone. And as we go into higher time frames and multi-time frame analysis, you'll start to see that. So it's very important to remember that once we have the break of structure, at some point in time in the future, price is we can assume that it will trade back into this zone, and then at some point in time in the future, we can assume that it will continue the trend in that direction of the break of structure. And so now that we got those pieces kind of clarified, I just want to really talk about the range and what that means. And because I think a lot of people have a hard time with this, and I think it gets overcomplicated. And I think that, hopefully this lesson can simplify it. So once you have a break of structure, as soon as you have this break of structure, the range now becomes from that break of structure to the low. But because price trades higher in most situations, the range is now whatever that high is in the pullback. And that range, all it means is a newly created range that smart money can now reprice and take prices lower into before trading on into the future. So to break that down, once this high is taken out in this example, we now know that it's very likely that this low will be protected until at some point in the future when price eventually trades back through it. But we'll get into that later. Right now, all we need to understand is that because of this break of structure, price will at some point trade back down into this low and continue the trend. And this is all smart money is doing is repricing this. So smart money is actually selling here. They're aggressively selling to bring price down into to then buy and take it up again. And so this range is basically how we can define if price is expensive or cheap when we frame a trade. And so that's really the point of a newly created range, is to help us define. There's going to be many things that we add to this range as we go through the course, but right now all you need to understand is if it's expensive or if it's cheap that you're buying or selling it. And so at this point down here, this is very cheap because smart money has driven prices down into a discount level of this range, which we'll go over in one of these very soon. Next episodes we'll go over, next lessons. We'll go over premium and discount, but it's very cheap prices down here. So this is how we can actually define if we're buying low and selling high, is using ranges and using newly created ranges. And so we don't know that it's a newly created range until we get the break of structure. But once we get the break of structure, we can say, okay, I would rather buy low at this low of this range and then sell high than try to buy somewhere right here at the breakout and ride the trend up, because we all know that doesn't work. We're not breakout traders. Breakout strategies fail, all the time. So yeah, using the newly created range here, we can understand that, okay, when price comes down into this range, that's a fair value to purchase this instrument and continue with the trend. Okay, so with the break of structure, we know that price is going to trade back down into the range at some point in the future. It doesn't have to do it immediately, but at some point in the future, it's going to trade back down into the range. And that break of structure also signifies that the trend is likely to continue in that direction, which in this example it does. It, in just a couple candles from this low, almost clears that high, fails, comes back down, and later on in time, that trend does continue. So that is an example of a bullish created range, and I want to show you an example of a bearish range here. And so this is not a huge range, but this is an example that you can find, because on a lower time frame, when we actually get into that, you'll be able to understand the swing structure that's happening on a lower time frame, and this will still be a range on some degree. So there might be traders that are looking at this and saying, well, this is just a little bounce and a small little pause in price before it continues. But there's also going to be people who trade this on lower time frames, on the 1 minute, and can take a trade in here. So this is a pullback and then a continuation and a break of structure. And at this break of structure, we can now say, okay, this is a newly created high, a newly created lower high. And then when we see price start to pull back, we can say, okay, now this is our newly created lower low. And at that point in time, when we start to see price pull back, we understand this is our range that we're trading in. From this high to this low, we would be framing shorts to continue the trend lower with our expectational order flow, that because price broke this direction, we then know that price is likely to trade back up into this range at some point and continue the trend in the same direction that price broke that old low. And so it's the same thing, just opposite. We are waiting for price to pull back up into this range to find cheaper prices, or to allow smart money to reprice this instrument before looking for a trade to take it lower. And so that is a range. Basically, as soon as you get a break of structure, you know that we have a newly created range, and you know that it's likely, and it will become more and more likely as we add in different confluences throughout this course, that price will trade back up into this and respect this lower high and continue on. Basically the pullback, continuation, break of structure defines a newly created range here. And yeah, it's the same thing over and over again. You can go through your charts and mark that up, and I'll leave this video here and we'll see you in the next one.